Hi, everybody. Welcome back on the Blockworks Macro channel. This is Alf speaking, and today's guest is a Twitter rising star. His name is Mr. Blonde Macro on Twitter. If you don't follow him, go follow him anyway because he's great. Hey, Mr. Blonde, how are you doing?
I'm great, Alf. Thanks for having me.
It's a pleasure to have you here, especially as yesterday we had a Fed meeting, which turned out to be relatively interesting, or at least market reaction straight away was pretty impressive, measured in volatility adjusted terms. So I want to start from there and give an audience your take on what Powell basically said yesterday.
Yeah. So, look, I should caveat that, in the way I approach markets in my framework, I don't put too much weight on any, single Fed meeting or, certainly any single comment from a central bank official. I mean, I try to certainly try to take into account what they're thinking and saying, but my framework is very much cyclical growth focused and looking out beyond a given meeting. I guess my conversations with market participants, it didn't seem like many were actually expecting 75 basis point rate hikes, but so I'm a little bit surprised that the market was took that part and ran with it. I think if you look at pricing, it doesn't seem like Fed funds pricing changed all that dramatically. So I get it. I mean, I guess we kind of cut off a little bit of the hawkish tail, but I'm not sure that it really changes the narrative all that much about where the direction that the Fed is heading and the need to lean against inflation. Certainly Powell was a little bit more relaxed about it, and that's soothing. I'm not sure, and I think you wrote about this. I'm not sure that will prove to be the best tactic in fighting inflation over the course of the next couple of months. So I would say I understand the market reaction and the excitement. It doesn't change the big picture view and where I think we'll head up. Where we'll head in 6 months. So inclined to kind of lean into fade it a little bit, but not aggressively. Recognizing sentiment.
So what I found interesting was a couple of things that he said. When he cuts out the risk of a 75 basis point hike, either in June or in the next meetings, he basically truncates the distribution of future outcomes that are possible, right? And that normally, he did that in March already. That generally helps people to have a better understanding of the path ahead, lowers a bit implied volatility temporarily. People can buy more stocks, can feel a bit more aggressive. But what he also said was that the Fed is fine in doing consecutive 50 basis point hikes at the end of the day, assuming that financial conditions will move according to expectations. And it sounds like he's trying to navigate a bit this financial conditions tightening while looking very serious about inflation. But which of the two, Mr. Blonde? I mean, he can't achieve both, I think.
Yeah, no, I think that's a very good point. And I think that this is sort of also why we're in an environment where, you're inclined to fade rallies, because to your point, I mean, financial conditions tightening is a key part of what the Fed needs to do in order to, get a handle on things. So that puts a ceiling on risk, right? And how far it can go. So, look, obviously we can, we could trade down and we can bounce and whatnot, but that gets back to the point of, what kind of, how much risk you want to take in your portfolio, knowing that the Fed is there to kind of lean against you if it goes too far. I think the other aspect that I thought was that's important is he talked about he's still kind of talking about the idea of a soft landing, but he's not at all committed to it, right? So and I think that's maybe a recognition of the difficulty ahead in fighting inflation. In the context of tightening on financial conditions and knowing that this is the cost benefit analysis, right? The Bernanke used to talk about it in a different way, but this is the cost associated with hitting of inflation is likely to be a much more difficult growth outcome than they would desire. Yeah.
And interestingly, markets are like, yesterday they reacted, making financial conditions very loose all of a sudden. So you had the dollar down, you had equities up, credit spreads tighter, the whole bunch that the Fed doesn't want to see happening, right? Including inflation expectations shooting higher after the meeting. Today, though, it seems like markets are having already second thoughts. So all of the moves yesterday are getting reversed. So ultimately, do you think the market believes that the Fed can achieve somehow both? So making only a gentle tightening of financial conditions while lowering inflation expectations? or they're going to force Powell basically to choose between the two?
I mean, I think there are certainly people out there who believe that they will, but I think the outcome will be the latter. So, and I think that's just, a function of, I wrote a piece late last year called "Don't Fight the Fed," on the Substack, and sort of reviewed all of the, historical Fed rate hike cycles. And I think that, one of the key takeaways from that is that during the early phases of tightening, or when they start the process of tightening, markets are always volatile and skittish, and sort of you kind of go into these really wide, trading ranges, which is not uncharacteristic of an environment where you're sort of, draining liquidity. Now, typically in a Fed cycle, you're also in a much earlier stage of the economic cycle and have, a lot more growth to help offset, the inevitable valuation compression. But, point being that I think that volatility is something that we should expect to hang around for some time until we start to see, kind of, for a lack of a better term, the fruits of the labor from the tightening, right? That you start to see inflation come down, growth rates come down, and you get a better sense of the severity of those of that direction or the trajectory in those indicators, and we're further along in the cycle. And then obviously, we've talked about this and we've seen it out there. I mean, there's also a pretty big difference between slow, moderate cycles and fast cycles, and this certainly is a fast cycle in terms of its magnitude, and that that's always a more severe outcome. So I think volatility is the one thing that we can be sure of.
Yeah. So let's start and zoom back from the Fed meeting to your overall macro understanding, because you are very good at identifying turning points in the macro cycle, and those turning points generally take a couple of months or quarters to unfold. And the Blockworks macro interviews I'm doing are rather educational, zoom out interviews than only focus on a topic. So what do you see happening over the next few quarters? What's your macro assessment, big picture here?
Yeah, this is I think that this is an important point, and and a key part of how I face markets, which is I start with it, having a macro growth kind of framework and thought process, and it's largely cyclical driven. It's not it's not like potential growth or the really long-term growth measures. It's shorter term in nature. But I have a good chart that I think kind of represents this framework for me. It's called the macro growth composite in the slides that I sent you. And that composite is really has heavily focused on profit growth. Mm-hmm. I'm a equity investor, so profit growth matters to me. I don't really care about GDP growth, and we don't have to get into that today, but that doesn't drive my thought process. But my macro growth composite is just a mix of different indicators, kind of a long indicator, a medium indicator, and a sort of a short indicator of profit, the cyclical profit growth. And on all those measures, we're in a slowdown mode, right? I mean, we've peaked and growth is slowing. And my framework suggests to me that come the second half of this year and into the first quarter of 2023, that macro growth composite will dip into sort of negative territory. And as it pertains to profit growth, U.S. profit growth in particular, that looks like it will be negative in the early part of 2023. And I think markets will struggle, as they see that. And markets are tend to be a little bit forward looking. Call it 6 to 9 months, and so I think that'll be a big part of the second half of this year. And so I think to kind of underscore this, the way that I've tried to explain equity markets and earnings growth to sort of a fixed income macro investor like yourself is to think about earnings growth as a form of carry. So when earnings growth is rising, or you have an upward sloping EPS curve, meaning EPS next year is higher than EPS this year, you want to buy steep yield curves, right? So in the context of equity markets, you want to buy steep EPS curves if they exist. But if that EPS curve is flattening, or you have a situation where growth is slowing and or revisions are negative, then equity markets no longer have the positive carry attributes that they would typically have. And I think that's how we should think about it, right? Carry in the equity markets is actually pretty flat right now, and I think will be turn negative as the year progresses, if that helps to
absolutely
frame the debate.
It's great framing. And actually, if I think of earnings like carry, and I think that looking at your framework, basically you're talking about earnings growth which is going to disappoint on the downside. The other reason why people tend to buy equities is because of valuation expansion, multiple expansions, right? So maybe the return is going to come from there. Open question to you.
The reason I frame earnings as a form of carry is because what most equity analysts will do is they'll model earnings and then their valuation assumption is flat, right? I mean, it's the PE multiple is basically unchanged, from point to point. And the community is generally not good at forecasting valuation. It's difficult because it's the residual by definition. It's, very much, sentiment, but it also has, and this is more of a macro equity perspective. I mean, valuation is also very dependent on the regime and the environment that you're in. Sure. So if you're in a high inflation regime, all else equal, valuation is lower. Valuation is lower partly because typically in a high inflation regime, the Fed is a much more proactive and raising discount rates, and that leans against valuation. But it's also lower because high inflation regimes, all else equal, apply margin pressure on corporates, right? And so margins and valuations are typically move together. So no, I don't think that it's sensible to expect that you're going to get any any benefit from valuation expansion over the next 12 months. Certainly not as long as the Fed is in the early stages of their hiking cycle, and we still have to calibrate what happens. But then also the other factor is as growth slows and as the market comes to appreciate that growth could be negative in 2023. That's not an environment to pay a higher multiple for stocks. And then the last point, and I'm sorry I didn't include a chart on this, but it's in on my Twitter feed and in the Substack notes. I think the other thing that I'm personally struggling with a little bit is that when we look at valuation, we're also dealing in an environment in a period of time where EPS or earnings are well above trend, and so you have a situation where it's hard to trust that level of valuation given how extended earnings are relative to their 20 plus year trend. That's a pretty unique set of circumstances.
Yeah. So the natural question I have is, if you have an overall negative assessment of where earnings are going in your base case against where analysts expect earnings to print at the end of the year, and you also don't expect valuation to help the overall equity market, then I have to assume overall you want to be bearish here. But we're talking about indexes, right? I mean, macro indexes. Is there a certain sector of the equity market that maybe looks like an overweight against something that looks like an underweight to you?
This is a good point. I mean, I think there's two things. One is, S&P 500 is the most commonly cited and referred to index, and for good reason, big liquid US market. But it's important to recognize and appreciate, by definition, it's also one of the most resilient, portfolios in the market. It's a good mix of cyclical, defensive, growth, value. Obviously has big liquid brand name companies, so it's not the ideal instrument to use to short. I mean, I do think that it will continue to come under pressure for the reasons that I said before, and we're at a stage in the cycle as you move later and later in the cycle. Increasingly it becomes a broad market issue, not just a sector issue. But look, I would say that I continue to think that consumer facing stocks will come under pressure. I mean, so for me, for most of the last year, I've favored to kind of be short or significantly underweight like consumer cyclicals. Mm-hmm. XRT would be the benchmark ETF that kind of encompasses this, and that's actually very typical and consistent with Fed cycles. But it also, I think, represents some of the tension points that we have today, which is high commodity prices, higher financing rates. Things of that nature. So I think a broad basket of consumer cyclicals that ranges from, specialty retailer, including home builders, probably still, as long as the rate cycle is where it is and activity slows, and other consumer durables, like autos, are all, probably good places to target on the short side.
And then if I really have to try and test you on the long side, what would you want to try and be long anything here?
I'm going to, kind of show my stripes a little bit. I tend to be somebody who's, primarily attracted to what I would call, high quality, profitable growth companies.
Mm-hmm.
I think it's I think, obviously you have to be cognizant of valuation, but, more often than not, it's a situation you get what you pay for.
Mm-hmm.
So if you pay for a company that has high gross margins, stability in gross margins, or stability in the, in profitability, I think that those are the features that you want in an environment where inflation pressures, are kind of lingering. It's hard to put it into a specific, kind of ETF. I mean, for sure, tech as a broad category, has those characteristics. I mean, tech obviously is a space right now that's pretty controversial because of rates. I kind of think that can subside later this year. As I talked about, as growth is slowing, inflation is coming down, and maybe we have a better handle on where the kind of the Fed cycle ends up. I think it's important to be, kind of selective within that space. One of the trades that I've suggested is to be long software and short semis, which I think, kind of is a little bit of a play on long, the, kind of stable profitability, recurring revenue type, business. Software, obviously, I think also benefits in an environment where corporates are looking for more productivity and to get more out of their labor, in the context of, rising wages. And I think semis are a group that are cyclically vulnerable to, the retracement and payback on consumer goods consumption that we've seen over the last couple of years. And so, I kind of like that pair. It's kind of a little bit of a cop out, but I guess if you wanted to take from that, you would say that, I want to be long, software stocks from here. And I'd be comfortable being long software and short consumer cyclicals. I'm okay with that construct. It's pretty similar to what my portfolio looks like.
If we move away from talking about the Fed and the stock market, you look at overall global macro, I should say, or broad macro asset classes. Is there anything that really talks to you at this stage in terms of risk reward, or anything very interesting you see in currencies, commodities, gold, or other asset classes?
I think that the thing that's interesting to me right now is actually kind of the divergence between credit risk premium and equity risk premium. It leads me to think that there's better, if you want to take long risk today and you're comfortable with the growth outlook and you're comfortable with, inflation and the Fed, and you're getting comfortable with those things, I think you're getting compensated, well, on a relative basis. You're compensated to take that risk in credit more than you're compensated to take that risk in equity. Mm-hmm. Now, it's a little bit tricky because, in credit, obviously you have a fixed income stream, and equities, you have a variable income stream. And so there's an element of that makes sense. But it's at least over the last 10 to 15 years, pretty notable gap between those two markets. And I think that kind of dovetails with what you asked before about valuation. I mean, when I look at this, that it makes me think that, equity is a little rich relative to the set of, macro conditions, and that's, that can happen in short periods of time. But, so that's interesting to me. I don't know that I know exactly, what to do with it at this stage, but it's certainly on my radar. And then the other thing I would say is, and, I'm a tourist in your space, but I'm attracted to the idea of this is, for me anyway, the first time in a few years, adding some long duration to the portfolio. I think it has to be sort of measured, and is, the sizing at this stage is pretty light, but with the idea that come, kind of September of this year, that the market narrative is quite different, and we have a much better handle on, where we are in the Fed cycle, and the market will start looking into 2023. And if I'm right about the growth cycle and the sort of the rising risk and concern around recession, then maybe we end up with a more volatile Fed cycle, and they end up having to cut in 2023, which would be sooner than I think is currently expected. And so I'm kind of, I like that idea. I mean, so far for me, that's a pretty small measured trade, and something like TLT call spreads. Mm-hmm. You warned me against it, and it's currently a little painful, but it's okay. I mean, I think I'm trying to think 6 months out.
Yes, and indeed, time horizons are very important. We discussed it before the interview. Many people on Twitter who are fighting on the same trade and perhaps they just have a different time horizon. It's important to specify indeed what your regime time horizon is in your assessment. You talked about credit, and I have a question there. So, if the Federal Reserve is looking to tighten financial conditions, I think they told us pretty clearly that they want that to happen to slow demand. If I look at the components of financial condition index, there are generally 3 or 4 well-known: interest rates, equity, credit spreads, and the dollar. Uh, do you think they have any preference in targeting specifically one of those, although they'll never admit it? But do you think there is a channel that they would prefer going there?
My sense is that the most effective form of financial conditions tightening from their standpoint would be one that impacts sort of all of those areas to some degree to help create a more balanced attack on financial conditions tightening rather than, and probably an undesirable outcome would be if all of the financial conditions tightening was happening in one specific bucket, which, I think could be ineffective or less effective, but also, potentially damaging to that particular market or disruptive to that particular market. So look, I made this point on a Twitter post that I think is something that maybe doesn't get quite enough attention, but the dollar's moved quite a bit recently.
Yeah. Yes.
And I happen to think that that's an important part of financial conditions tightening because it's a fairly blunt instrument and is pretty far reaching into all the little cracks. And I think that if the dollar's stronger, it has inflation, fighting, implications. It also impacts growth because the cost of doing something, changes. It changes the valuation profile of your capital markets. So I think that that's pretty important development. It's kind of been ongoing, but the pace has picked up. But I think that that's also a reason to think that maybe the idea of all of the tightening having to be done in rates, that view might be missing something if we're not also considering the dollar in that equation.
And that's a very smart point. I also yesterday put out a chart from Bloomberg that shows that the trade weighted dollar has moved over the last 20 days, I think by 4.5% or 5%. And if you look at a 20-day rolling move over the last 20 years, it's actually pretty rare to see such a move in trade weighted dollar in such a short amount of time. It is a wrecking ball, basically, for many levered emerging markets or corporates that are levered in dollars. They see global trade slowing down. They need to refinance maybe the liabilities. They have less access to dollar trades or dollar profits in general. And so they have basically they need to scramble back to the dollar. Plus, there is the interest rate differential story that we all know, and all of that. It's an important remark. There is the last question I have for this interview covers one market that you have been relatively vocal about, and you still are, which is the housing market. And so the housing market is not in the financial condition index, in most financial conditions index. Surprisingly, because it is the biggest asset class in the world. But so can you explain your stance on the housing market?
I think rates and the lowering of mortgage rates over the into through the COVID response in 2022 2021 was a key factor in what drove housing prices. Now, obviously, there was a bunch of other things, and sentiment shift on work from home and other things. The housing market had good macro fundamentals before COVID, and the things that happened and the policy response from COVID only accelerated and encouraged activity there. But I think one of the things that concerns me is that when you look at home prices across all different MSAs, I had this chart in a note, but you had an extremely high correlation in a rising home price market. And when I think of correlation within markets, I always think of very high correlation as being an unhealthy a measure of something that's unhealthy. And so in this case, it usually happens when prices are crashing, not when they're rising. But in this case, it suggests that the lowering of financing costs basically just pushed the prices of everything higher. So I don't think that's all that controversial. But I think what will happen now is that as mortgage rates rise and have risen significantly and quickly, we should see the correlation across different geographies and cities come down. And what will happen is in some, I'll use US as an example, but in some, MSAs, prices will fall because the fundamentals don't support it. Other MSAs will be okay and stay firm because the fundamentals do support it, whether that's, different forms of migration or whatever, tax policy, other things in that region. And so that should create more dispersion. So my view is not so much that housing prices will come crashing down. I think they'll slow to a crawl. Some regions will be negative. Some regions will be positive, and net at the national level, we probably are like, plus or minus a couple percent, but a very manageable number. Where I think housing is more at risk is in activity, sales, foot traffic, transactions and things of that nature. Now that obviously can contribute to price degradation, but I think that sort of is where like a lot of the activity that's happened was speculative in nature, and that can change, including on the investor side. Look, a lot of people say like, oh, but all the investors. Well, now the investors have like viable liquid alternatives to return. They don't have to put their money in an illiquid piece of real estate, and instead they could buy corporate credit at 4.75%.
Sure.
Or whatever. Like there's or they could buy mortgage, MBS or something else that, kind of has the same, fundamental characteristics, but is liquid and spreads have widened. So I think that's my thinking, is that it will, from this, for the rest of this year, it will be about activity. Prices will kind of follow. I don't think prices are gonna, I don't expect prices to crash. Certainly don't expect them to crash, and think that it will be, kind of more of dispersion. Fundamental dispersion is the story in housing, across different regions.
And what do you make of the tight supply or tight inventory story? Because that is the main argument that housing bulls, and bulls, I mean people that are expecting another double-digit percentage price increase this year in US and in Europe, actually always put forward. What do you make of that argument?
Yeah, I think it's a little slippery, because I feel like if you look at what I would call shadow inventory, so I'm attracted to the idea that you have a lot of quote unquote homes under construction, right? And this is like, to me, what you have to do, and who does a good job of this is the Calculated Risk blog, has a good chart. But if you look at homes under construction, you look at homes for sale, homes under construction, plus homes not yet started. If you look at those three categories and you add them all up, and then you look at inventories over time, inventories today have only ever been higher in the 2008 period, or like 2006 to 7, 8, like that little, surge in inventories. And my point on that is that there is a lot of what quote unquote shadow inventory that's like a house that's under construction that's like missing a dishwasher because it's on a boat in Long Beach or whatever. But once that, and you can't sell it until it's complete. But once that's complete, then it's, now it moves to homes for sale. And so that process can actually move pretty quickly. Now, then I think also important to consider the person who bought that house, if they were not a first-time home buyer and they were in an existing home. Now, when they go to move into their completed new home, they have an existing home to sell. And so, but now they're selling that existing home into a market where conditions are far less favorable than when they originally signed up to buy that new house. So I think that dynamic and that process, and I think we'll have to see how it plays out. But my sense is that there's more inventory than often is stated when we look at kind of a headline metric like homes for sale. Obviously, people will disagree with that perspective, but I think that's something that I'll be watching closely over the course of the next 6 to 9 months. I feel like inventory and supply is one of those things that's a little bit slippery, right? I mean, demand can kind of converge towards supply, and all of a sudden supply cannot look so tight anymore.
Yes.
When there's less, when there's a little less demand.
Indeed. So, Mr. Blond, your measure takes are always appreciated, and I'm pretty sure that the Blockworks macro crowd here has learned to like you if they didn't know you already. But if they want to follow more of your work, where can they find you?
Sure. Well, I mean, Twitter is like the easy way for regular sound bites at Mr. Blond _macro. And then, I write a Substack. I try to keep it, kind of every 10 to 14 days. My views don't change that frequently, but you can find me at Substack. It's Stuck in the Middle at Substack. And thank you for having me and checking in.
Well, Mr. Blonde, I can only thank you for being here, and I can suggest the audience to go and check your Substack. Absolutely awesome. We'll put it in the link notes as well. And if you like this kind of conversations, guys, subscribe to the Blockworks Macro channel because you're going to be hearing more of those. Thanks, Mr. Blonde, and talk soon.
Great. Thank you.